Welcome to the Daily Update, where I'll go over the action in the market for Tuesday, October 17th, and then we'll see how things look for Wednesday, October 18th. You may end up hearing a little bit of background noise. I have some noise going on around me that I can't really control right now. It starts and stops intermittently, so I just kind of have to go ahead with this anyway. All right, we had pretty much an unchanged day, but we ended up closing down, so that goes in the books as a negative day. But believe it or not, some of our short-term indicators are showing even a bit more of an extreme positive reading. We're kind of sitting right on this plateau right now, and we're chopping sideways. So we're not trending, but for right now, we're still looking more positive. A solid down day could wipe all that out, but a good solid up day could also switch things over and make them look more positive. So let's go back and talk about what happened. Right at the open, we had a gap lower open, and prices fell down below S1 at 43.50. We then rebounded up off of that. That was the low for the day. We got above S1, above the daily pivot at 43.66. We went above the unchanged level, so we went positive, and we went up to R1 at 43.91. Then we fell back below R1. We fell back below the unchanged level, and then we spent the rest of the day just chopping along the daily pivot going into the close. So we were down 0.01% on above average volume. We're still looking okay technically right now, but a big move up or down could switch that, and we're not trending right now. And it has a lot to do with the geopolitical events, with what's going on in Israel, and also what's going on with the Speaker of the House right now too. Some comments. Mega caps in growth underperformed in Tuesday's session. This is where we're getting a lot of our buy low, sell high, and strength from in 2023. When they don't have a good day, the indexes don't have a good day either. But small and mid caps did outperform. Now, they're not looking all that great, and they have a lot left to do to improve. But the fact that they had a pretty good up day where the mega caps and growth stocks took kind of a day off, we just want to make note of that. The micro caps bounced up as well, but they're still near that new 52-week low. On a short-term basis, we have our Stochc RSI, the Williams Percent R, and the stochastics, which are giving extreme readings. We even have a couple of intermediate-term extreme positive readings. The S&P 500 McClellan oscillator, and that could also be taken as positive because it's showing more broad participation within the S&P, and our PMO studies are starting to get a little extreme. The scenario that we've been working with is the same scenario that we've been dealing with, that the market is concerned that the economy is stronger than expected. That will mean that the Fed will not only keep rates higher for longer, but also possibly raise them at some point. They're concerned about the Chinese economy, and so China's putting a lot of stimulus into their economy right now, hoping that that will improve things. Geopolitically, with the Israel war going on right now, keeping an eye on oil prices, and then we're coming into earnings season, and a good earnings report could really push things higher. A bad report could take things lower. The dollar was up and interest rates were also up, and that's putting some headwinds in stocks' way. The 30 to the 5 has still gone back to being normal, where the rest of our yield curves remain inverted. Sentiment didn't change. We're negative at 35, but we were at 35 after yesterday's market. Our trend still shows that we're not trending, and we're negative. The red line is still on top with both the short and intermediate term chart. It's a weakening non-trending environment because the ADX is below its moving average. I've kept our bias at positive for right now. You could have gone either way with that, but our momentum is still mixed. Economic reports that came out. This was a big one. We had total retail sales come in up 0.7% month over month, a lot more than the 0.3% they had expected, and also a little bit down from the 0.8% that we had last time. This was stronger than expected. The market could have tanked on that, and that's some of the reason why we had the lower open. If you take out autos, we were up 0.6%, a lot more than the 0.2% they had expected. Last time it came in up 0.09%. Industrial production was up 0.3% month over month. They expected it to be unchanged. Last time it did come in unchanged. Capacity utilization, it's still below that 80 level, but it came in at 79.7. They had expected 79.5. Last time we did get 79.5. When you compute that out on a year-over-year basis, industrial production is up 0.1%, nothing all that great. Capacity utilization year over year is at 79.7, again, below that 80 level. When the economy is stronger and really expanding, we get above 80 with this reading. The NAHB Housing Market Index came in at 40, less than the 45 they had expected, and down from the 44 we saw last time. Business inventories were up 0.4%. Last time they were up 0.3%. Actually, that's what they expected. And then last time it was up 0.1%. There's a typo there. So here's the year-over-year sales, where we're just kind of going along sideways, not really seeing a big increase or decrease currently. Month over month, we did show a bit of a decrease, but we're still positive. Capacity utilization, that's the yellow line where it's flattening out right here. And the blue line is production, where they're pretty much going sideways right now, not showing weakness, but not showing strength. Here's capacity utilization right underneath 50 after we had been above 50 for a while, and then we fell back. On a month-over-month basis, industrial production was up. And then looking at business inventories, where we had been at 0.1%, we climbed to 0.4%. That just means that companies are keeping more things on their shelves, which could be good because if people want to come in and buy something, it's there, but it could be bad because it's not going out the door to be replaced by something new. Then looking at the NAHB Housing Market Index, where it has been declining overall, and we're seeing some weakness in real estate. Keeping an eye on the 10-year yield, we're at 4.85%. Interest rates did go up in Wednesday's session. Here's the intraday chart where we gapped lower, and then that set the low right there. We came back above the daily pivot, above the unchanged level, a little bit above R1 before falling back below the unchanged level. And then we just kind of danced along the pivot point. We saw a little bit of strength going into the close, which kind of saved us from being down a little more than we were. Looking at growth versus value, we were up slightly on the day, but value did outperform, even though longer term on this intraday chart, the blue line is still above the red line. And this is also a concern. We're seeing this for the second day in a row now, where we've been seeing a nice advance of growth outperforming value for the S&P. Well, it's starting to trail off a little bit now. So that's a bit of a concern. On an end of day basis, we're still looking good overall, where we've been breaking out with the S&P growth versus value, but we ticked down slightly on Wednesday. Here's our trend where we're below 20 with the ADX. We're below the moving average. The red line, even though it's really hard to see here, it is on top, just barely, where the green line is underneath. So we would default to negative according to this chart, but we're in a non-trending environment. Also in the short term, we're not trending. We're below the moving average and declining. The red line is just a little bit above the green line. So here we would also default to negative with this chart. But now we have other charts that are looking more positive. We're also keeping an eye on the VIX. We're in the middle part of October now, where a lot of times on a historical basis and on an average basis, we tend to top out with the VIX and then see that go down following what happens in the middle part of October going into the end of the year. We don't know if it's going to play out that way or not. Looking at the Ulcer Index shows that fear is starting to decrease. The VIX is seeing a little bit of an uptick on the line chart, but we're still below 20. We also closed about in the middle of the bar with the bar chart. Volatility of the VIX is still above its moving average, both with the line chart and on the bar chart, but we were pretty much unchanged. The VIX to VVIX ratio continues to go up, which is negative. The 5-period simple moving average of the equity put call ratio is continuing to go up, and we're getting up into this extreme reading again. That is negative. We're going to wait to see, will this top out, turn around, and start to come down? We've had this happen a number of times now, and it hasn't really led to anything. We'll just wonder if it's going to be different this time. The longer-term equity put call ratio continues to advance. That's longer-term negative. We're seeing a bit of an increase in fear with this fear gauge. The advanced decline line based on price is showing some improvement. We also bounced up slightly based on volume, but we're still below the moving average. We're seeing the new highs, new lows show a little bit of an improvement here, where we're seeing a real expansion of new highs and a real contraction of new lows. That's internally showing some strength. And that means that it's going beyond just the big mega caps, where we're advancing with our 5-period as well as our 10-period moving average. We're looking more positive with the advanced decline ratio. The blue line and the red line are both above 0. Accumulation distribution still is looking more positive. We're above an advancing moving average. And I haven't shown this in a while in the daily video. We're looking better when we look at our advanced decline line studies with the NYSE based on common stock. We're coming back up to the moving average with the S&P and the mid caps and showing some improvement with the small caps. The CMF, the Chaikin money flow, is continuing to look more positive, even though it dropped back slightly on Wednesday. Here is our daily chart. At the bottom, you can see where we're above average with volume. We're still dancing along this longer-term trend line. If we go up, we've got the 50-day moving average to deal with, and we also have this other green trend line that may act as overhead resistance. If we fall back, we'll be seeing if we can stay above this trend line or if we're going to fall below that. On a volume basis, we're still a little bit above average when we take it together, looking at this indicator. The force index, it dropped a little bit, but it's still positive. In the short term, the stochastics are extreme positive. Intermediate term, they're extreme positive. Looking more positive in the long term, but still below the midpoint. The 20-period triple and double exponential moving average study, we're still closing above both of these prices, and the green and the blue line are starting to get a little closer to each other. That's showing some improvement on a trend basis. And we're above both the simple and exponential moving average with our 20-period study here. We're just chopping along sideways like we're keeping score or something. The Stochh RSI is still extreme positive, and the Williams percent R continues to be extreme positive. The CCI charts have fallen off. Looking at the NYSE cumulative advanced decline line, we are showing some improvement here. That's good for a broader market measurement. And we're seeing a little bit of a tick up with our regular NYSE advanced decline line. This is a little bit negative. The Swenlin trading oscillator is continuing to decline based on price and volume. That's how they're moving, but they're still positive because both of them are above zero. We're still going sideways with our go, no-go system with the lighter shade of purple. The TTM squeeze is turning more positive on a momentum basis. The balance of power continues to be positive. We're a bit above the midpoint with our highest high, lowest low values. We're still looking okay with the vortex. The green line is going up as the red line's going down. The ease of movement is above zero and advancing. The BPI continues to be positive. And here's where we're getting a little bit extreme with the S&P 500 McClellan oscillator. We're climbing above this line here. Now, we could go a lot higher from here, but this is just something that we want to make note of. So our summation index based on price and volume continue to advance. The NYSE summation index based on price and volume are also advancing. We continue to be positive with the S&P Elders Impulse system. The RSI based on 14 and 9 periods rolling over a little bit with the 14, but still above 50, and also going flat and above 50 with the 9 period. On balance, volume did close down just a little bit below the moving average. This was a very early indicator to be developed, and it pretty much takes it. If we have an up day, all of the volume goes positive. If we have a down day, all of the volume goes negative. There's really no buying or selling. It's just taking it either plus or minus. Well, since we were slightly down, this indicator ticked down just a little bit below the moving average. The Copic curve continues to generate a buy signal, as does the Pring bottom fisher. On a momentum basis, the PMO is still going up. We're also showing that based on price and volume. We're getting extreme with the PMOs that are rising. Now, this could also be positive. This is showing broader participation. The percent of PMOs inside the S&P 500 that are going up. That could be pretty good. We're also seeing an increase of the buy signals, and we're turning up with the PMOs that are above zero. We're ticking up. It's still below 50 with the NYSE bullish percent index. We actually ticked down just a little bit with the NASDAQ 100 bullish percent index. On a momentum basis in the short term, the slope oscillator is looking more positive, as is the MACD. When we look at all of our oscillators on all different time frames, they're back to being positive. We're below the 50-period moving averages. When we look at the exponential moving average, that's providing overhead resistance. It could be more positive if we could get above the simple moving average and then close above that, since a lot of people use the simple moving average. Looking at our 50-period double and triple exponential moving average, we're just chopping along this blue line here. And looking at the 100-period moving average study, we're above the exponential, but below the simple moving average. Looking at our moving average tree, we're just kind of in this spaghetti mess right now. Are we going to be able to break out and go up? Are we going to keep chopping along sideways here, or are we going to end up going down from here to help spread out some of these lines? We're a little bit above the midpoint with our standard deviations chart, so that's slightly positive. The Chaikin oscillator ticked up just a little bit, so that's a slight improvement, but we're above zero, so that's positive. The money flow is above 50 and advancing, that's positive. We're ticking down now with the ultimate oscillator, but still above 50. The parabolic SAR continues to be positive. We're still above this mini rainbow with our 20-period simple moving average of the open, high, low, and close. We're seeing a little bit of an improvement with the 200-day simple moving average study for the S&P, and also a bit of an improvement with the 50-period moving average study. So even though the large caps and growth stocks didn't really help out all that much, we are seeing some internal improvement. And then we're just still dancing along this long-term trend line. We continue to be above it. If we go up, are we going to hit this green line? If we go down, we'll break this support. And when we go down to this other green line, which is kind of like a parallel measure of this overall trend. A special K right on top of the red line. It doesn't know what it wants to do yet. Looking at Dow theory, we were up slightly with the Dow. The transports are finally coming back to where they had been having some problems, and we ticked up just slightly with the utilities. This is a longer term concern. I pointed this out yesterday. This is a Horchak method. After being on a positive buy signal for much of 2023, we're starting to see some weakness in this overall indicator, just something we want to be aware of. Also, keep in mind that this indicator is 1 day lagging, so I couldn't see it until Tuesday's video after I ended up getting the closing value for Monday. Then looking at the 10-day average of the S&P 500 highs minus the lows after getting extreme, we're bouncing back up. This is holding up for now. We're also above the midpoint based on price and volume with our 19-day exponential moving average of the advanced decline ratio. We're coming off of this new 52-week low, even though we were up in Wednesday's session. The Heikin Ashies chopping sideways, but looking better. The Kegi looking more positive. The Renko is positive, and the 3-line break is positive. The equal weight did show a bit of a bounce, but still underperforming the S&P 500 weighted index. And so we came down a bit with our overall ratio here, which could end up being positive if more stocks are participating. The Dow is still above this pivot point, still above its 200-day moving average, showing some improvement. The diamonds continue to be positive. The NASDAQ 100 is still stuck in between this red line, which was a previous all-time high, where we're hitting resistance, and between that and its 50-day moving average, and also dealing with this pivot level. We're going to wait to see. Are we going to break to the upside, break to the downside, or continue to chop sideways? We've switched back to neutral for the Elder Impulse system on the Qs. The NASDAQ 100 is still showing that momentum is positive, and we're below slightly the 50-day moving average for the NASDAQ. If we could get above that and close above it, that would be more positive. The small caps, after just giving us a death cross, did have a really good day, but we're just chopping around and not really going anywhere. And the Russell 2000 index also chopping around, giving us now a death cross. So we have confirmation on 2 different small cap indexes. The RSI is still right at about 50, and the momentum is still looking more positive with the MACD, but this death cross is never a good thing. The small caps have switched back to positive for the Elder's Impulse system. The mid caps could be just a day or two away from a death cross here unless we really bust up out of this. So we're just waiting to see if that will happen. The mid caps have also switched over to positive for the Elder's Impulse system. This is also positive. The FANG index continues to be above its 50-day moving average. In our arithmetic scale chart, we're still above this longer trend line going back to 2009. Looking at our ratios between the QQQs and the S&P, we're still above the moving average. We're a little bit concerned about this with discretionary to the S&P. We're below the moving average, but we did tick up a little bit, and we're starting to turn down a bit when we compare large cap growth with large cap value, but we're still above the moving average. So with the large caps, we want to keep an eye on that. We're declining a bit with the mid caps as well as the small caps. We're turning back up a little bit with our 50-period exponential moving average of the new highs minus the new lows, but we need to get back above zero to turn this more positive. And here's our indicator. We continue to be above zero. That's always a good thing if you're positive on the market. What we need to see is this red line turn back up, which it's already done, and then continue to go up higher from here. 50-period moving average study, the S&P 500, after getting extreme negative, continues to bounce up, but it's still below 50. If it can close above 50, that would turn things more positive. I haven't been showing this one in a while. This is more of a broad market measure. Even though the broader market did better, we're still not out of the woods yet, and we're still not showing a lot of improvement when we look at the Amex, NASDAQ, and NYSE and take a 5-period moving average of their highs minus the lows. We continue to be well below zero here. If we could get back above zero, that would turn things on a broader basis more positive. The dollar continues to go up. And the financial sector had a fairly good day here. Actually was able to close above its 200-day moving average. We're in danger of seeing a death cross here if we continue to see more weakness. And then we're coming up to the new cycle now. This is a new 50-day cycle period. There's nothing necessarily magical about this. I've just noticed that over the last year or so, this seems to work. We have been going up from here. Does that mean we're going to turn and go down? Or are we just going to see a continuation as we go sideways or possibly go up from here? Looking at the 10-year bond yield, this is what really pressured stocks for the most part, was the real rise in interest rates as the 10-year yield went back up. The 30 to the 5, even though it's declining, is still looking back more normal. And I haven't shown this in a while. When you compare cash to the 3 to 7-year bond ETF, we're starting to spike out to the upside. I did show this over the weekend, but this was a pretty big move, so I wanted to bring it up in the daily video. This just means there's a lot of uncertainty about interest rates. Also, looking at shorter term bonds, where they're outperforming further out bonds, which means there's even more uncertainty about interest rates right now. People are wanting to get into the shorter term bonds because they can get in and out of those and have an attractive yield without locking themselves into further out bonds. Then comparing the 10-year yield and subtracting the German 10-year yield, we're continuing to advance. The dollar continues to advance, and the correlation between the two is still fairly strong. Tom Bowley's research, we're in the middle part of October where we do tend to see some positive seasonality. After that, things could turn negative for a while before we see some positive seasonality at the end of the month. So what's our outlook for Wednesday? The UAW strike is still happening. The whole speaker thing is just crazy now. They had selected Jim Jordan to run for the House seat, and apparently he didn't make it. So now they're back in their rooms trying to decide what they're going to trade and do and all this stuff. And it's like a 7th grade dance game going on here. Everything that's going on in Israel, and my understanding is the president is going to go over there. That will certainly change things for sure. Our technicals are improving and turning more positive in the short term, but we're back to becoming more overbought, as you saw in some of our indicators. We will get the weekly MBA mortgage applications index, and the big one, if there is a big one in Wednesday's session, will be housing starts and building permits, because these can be forward-looking, a leading indicator. And then pretty much what's going on in Congress right now, and then everything that's unfolding in Israel. We'll have to see how all that plays out and how it affects the market. Here's the updated calendar, where we will get existing home sales on Thursday, as well as leading economic index, and then we'll get the Treasury budget on Friday. The Stock Traders Almanac for October 18th, we're neutral to positive with the Dow and NASDAQ, where we're just flat out positive with the S&P. So we still have some positive seasonality. We're also in options expiration week, where we tend to be up 73.8% of the time. But be aware, we're down quite a bit. It's actually not real negative, but we're not as positive in the week after this when we hit the week after options expiration. We will be on the 13th trading day of the month, where during a pre-election year, sometimes we see some weakness during this time. Historically, that's the solid green line. That's where we're seeing the strength from. And then we're just watching this period as we go through the S&P 500 during a pre-election cycle. Here's the Carson research, where we might see some weakness later in the month. The NASDAQ also potential weakness, and S&P weakness later in the month. We tend to be up a little more than down, going back to 1950 during a pre-election year for the S&P. And then Bitcoin, it bounced up a little bit, but I don't think quite what people were hoping it would do. Here's a chart where we're just barely above the 200-day moving average, but we're still working off of a recent death cross. So our scenarios, we're not going with the down one right now because we're not trending. We're not going with the up scenario because we're not trending. So we're leaning more in that category of things until the ADX decides what it wants to do and actually turn and get above its moving average. We're still negative as far as warning signs when we look at the equity put call ratio with long term going back 253 periods. The 5-period continues to go up. That's negative. The risk on posture is just chopping around and not really doing much. The 50-period new high, new low exponential moving average study is negative, even though it ticked back up. It's got a ways to go before it can get back up and turn positive. The Russell and small cap index have now generated death crosses. Positive. We're still wondering what the daily special K chart's going to do. On a momentum basis, we continue to be positive with the S&P and NASDAQ 100. The parabolic SAR chart, as well as the BPI, those are looking more positive. The Copic curve has generated a buy signal, as well as the Pring bottom fisher. The Vortex is positive. The Staples to S&P 500 ratio, it ticked down a bit, but overall, it has been declining, which can be supportive for the S&P. The S&P 500 to utilities ratio is going up, even though it ticked down in Wednesday's session. The mid caps are working off of a recent golden cross, but they're in danger of triggering a death cross, another day or two below that moving average, and that could happen. Small and mid cap growth, it's chopping sideways, but it's still longer term positive. And the financial sector, also working off of a golden cross, it was able to get back above its 200-day simple moving average. So our conclusion, we're turning more positive now, but like I keep saying, a solid down day could wipe all of that out. A really positive day could really reinforce that. We're trying to figure out, is this just short term? Is this based on seasonality? Or is this going to develop into something longer term that has more conviction behind it? In the short term, we're positive, but we're still dealing with some overbought indications. We're turning more positive in the intermediate term, and we actually have a couple of at least extreme positive readings, where we still maintain a positive trend in the long term. Thank you. I hope you found this helpful. I hope you have a really good day, and I will talk to you in the next video.